but we're at market open now.
And we are off actually on the green side of the screen. That's about a 30-point jump on the Nifty that we are getting straight away. Mid-cap index also has opened on the positive side. Let's look at the movers on the upside then. M&M is trying to bounce back from yesterday's slam dunk, 1% higher there. Infosys, ITC, Wipro, even LTI Mindtree, these are some of the names on the upside. Okay, now we are on the red side of the screen. Dr. Reddy's, by the way, still continuing that move from yesterday, up about 0.7%. Market is now slipping, so let's look at the losers. HDFC Bank is the big one that's dragging things this morning. TCS is the other. L&T is the other major giant, which is on the downside. Apart from these key big boy blue chips, you have BPCL and ONGC, both those stocks starting lower. Sun Pharma is cooling off a little bit. Just want to check what Cipla is doing after yesterday's mammoth move. Cipla is absolutely flat, not too much. So it's a very cautious start, very range-bound right now, but the color has very quickly changed to negative. 19,635. Remember, yesterday's low was 19,603, so that's the first level that we will keep in mind. But it is some of the banks and some of the IT names that are key drags. HCL Tech is also on the lower side. Kotak Mahindra Bank on the lower side. These are the key culprit areas. But Nigel, I think more headlines coming through beyond the index as well.
Well, that's right. You know, Intellect Design Arena, that stock is up close to 6.5%. So that's off in style today. BEL, Vivek told us his numbers are quite good, so that stock is up close to 2.5%. India Bulls Housing Finance, after a while, we're seeing quite large volumes on that one. On the flip side, you have Railtel that's under some pressure. That's down close to around 5% as we speak. RVNL as well, a government offloading some stake out there, so that as well is a little bit lower. But clearly the stock, I think, of the first few minutes has to be Intellect Design. That one's flying away as we speak. I think JK Cement as well, JK Lakshmi Cement, beg your pardon. That one, in fact, started off on the back foot. It was down close to around 4% in pre-open. It's down close to around 3.5%, so a bit of disappointment coming in there. And ACC, well, the stock is up close to around 0.5%, building onto yesterday's gains. As we said, those numbers were very, very strong. It has valuation comfort as well. Explains why that stock has moved to the high point of the day.
I just want to pull up Ajanta Pharma as well. So yes, if there are two major result reactions on the upside, they have to be Intellect Design and Ajanta Pharma. Ajanta did a revenue growth of 7%, big margin expansion, and not just that, they are saying they'll grow 24% this year. That's the revenue guidance that they're giving out, and the market's really lapping it up. So these are some of the names on the upside in terms of the result movers. Yeah, otherwise, Delta Corp is the only other one. Otherwise, it's a little quiet, Prashant, in the overall market.
It is quiet. So just about a 20-odd point cut on the Nifty is what we have. Just a few more names, apart from Intellect and Ajanta. Motilal Oswal Financial Services, I mean, that stock is up 6%. It's coming up with large volumes. I'm not sure this is a results reaction or something, but
it is.
Okay, it is a results reaction. A 6% move, 866 on Motilal. Vesuvius, we pointed out yesterday, it was up 20% on the back of earnings. It's up another 6% this morning. So 3,400, decent volumes for this point in the day. I think we pointed out Delta Corp, 2.5% on that one. MGL is up 2.5%, but it's never one gas company alone, so keep an eye out on the others as well. We've got what else? NCC, which is coming up with a 2% odd pop. Thangamile continues to run, the jeweler, the Tamil Nadu-based jeweler. That's up another 3%. I think some 15% or maybe more since the results have come through, more since earnings just a few days ago. So Torrent Pharma is another one, which is up about 1.5% as well. RVNL is down. I think we highlighted that. Railtel is down 3.5%. So this entire PSU pack, which has done very well, is all down with government OFS and RVNL. Maybe people are anticipating the government to do something similar in other very good performing stocks as well. HPCL is starting a little lower. Motherson is down 2.25%. That's at about 98. Another one. And Lal Path Labs is starting down 4.5%. You'll hear from the management in about 15 minutes or so as we sort of begin this trading session. So that's basically the up and down of it. 30 points lower, 19,625 is where we are at. Manishi Ray Chaudhary is Asian equity strategist at BNP Paribas. Manishi, good to have you with us here. Thank you very much for your time. I mean, you look at broadly Asian markets. I don't know if you were waiting for that Bank of Japan decision today, but well, seems like it's nothing. The decision was delayed. Maybe they were having a few more chai, samosas and chai, whatever. But it's the last big central bank, and that's why I guess there was a fair bit of anticipation after that Nikkei report that maybe they will make a tweak, but nothing. So in that sense, that one large risk out of the way, what's your view, markets from here?
So, if you look at the Asian or emerging markets, as a whole, they have begun to revive in the second half, and that's something we also anticipated. In fact, in our second half outlook, we actually wrote that. We said that we're turning more positive on Asian equities in the second half of 2023 for two or three simple reasons. First, the monetary policy trajectory of the global central banks is much more visible now than it was about 6 months ago. One doesn't know whether the Fed would hike once more in September, but whatever that outcome may be, it's now clear that we're at the fag end of that rate hike cycle. Second, Asian currencies are actually stabilizing. They had depreciated all throughout 22 and possibly the first half of 23, particularly the first quarter. But now it's clear that they're likely to stabilize more. We also have a situation where the Asian central banks may actually be in a position to cut rates, from early 2024. Finally, we're also seeing more earnings estimate upgrades across Asia than we were seeing about 6 to 8 months ago. So some of the large sectors in Asia, like Korean tech, like Indian industrials, they have joined in, which wasn't the case earlier. When I look at closer home in India, it was only financials all throughout the second half of 2022 and early 23. But there are now more sectors, even in India and in the rest of Asia, which have joined in that club of earnings estimate upgrades. So these are clearly positive signs, and while we may still continue to have some degree of sideways movement in the Asian markets on account of the still prevailing recessionary concerns in the developed markets, broadly, the situation clearly looks better than it did about 6 months ago.
Okay, good to have that view, Manishi. Good to have a positive sort of statement this Friday morning. By the way, the market is selling off. I just want to point that out. We went very close to yesterday's low. Exactly took support there at 19,602 thereabouts. You can see the Nifty is pretty much kind of slid down to the lows of the session. Need to watch out for the banks. It's once again the banks that are leading the decline. Look at the bank Nifty now. It's down over 0.5%. And Manishi, that was my next question to you. Completely take your point that banks led the India rally last year. They are the darling sector for a lot of foreign investors. But what's happening now? We've got our share of foreign money right from April onwards. But the banking index, large banks, they've pretty much been sitting out or, they've been at the periphery of whatever move we've had so far in India. So what do you think is going on here? There's nothing wrong with earnings, at least as of now. Most large cap names have reported pretty healthy numbers.
Absolutely. I think it's that classic case of very large investments having gone in over the past 6 to 9 months. And therefore, investors taking a breather on a particular sector. There's nothing fundamentally wrong, as you pointed out. One thing we must, take cognizance of, which is that going forward, the kind of NIM expansions that we had seen for the banks, that's unlikely to happen. In fact, you might even see for some select banks some NIM contraction, interest margin contraction. So I think some investors are also taking cognizance of that. But if I look at the longer term, over the next 2-year, 3 or 5 year cycle, then the private sector banks in India are in a very sweet spot. We have credit growth about 16 to 17%. The private sector banking universe is constantly gaining market share. Their asset quality is very decent. And on top of that, we have a situation where the corporate universe in India is highly underleveraged. If you look at the top 500 companies, their debt to equity ratio is hardly about 45% or so, and that's a decadal low. So obviously, the companies, when they get into the next capex cycle, they have room to leverage upwards. So I think, this short-term underperformance of the banking sector is nothing to worry about.
Okay, so positive on Asian emerging markets, including India, for the second half, and no cause to worry about the banks. Got that. A lot of earnings today, so we'll have to keep it a little shorter this time around. Thank you very much for joining in, Manishi, and we look forward to a longer conversation next time. You have a good one. Well, with that, let's actually quickly get back to more numbers and earnings. Our next corporate conversation is lined up. Dr. Lal PathLabs reported a good set of numbers for the first quarter. Margins came in better than estimates. The non-COVID-19 business has actually moved very, very smartly. Bharat Uppalipan, CEO at Dr. Lal PathLabs, is with us now. Bharat, thank you so much for taking this call. So I think the market's taken heart from the fact that now, ex of COVID as well, the business is really growing. And it's a double-digit growth that we're talking about in the revenue. Can you give us a sense of what's happening with realizations? Is most of this growth volume-led, or is it also value-led?
Good morning, and it is good to be on your channel again. And if you look at our top-line numbers, we grew at 7.6% total revenue, and we also grew the non-COVID revenue by 9.7%. Now, when you break this growth in whatever form you want, underlying point is that we have had a good realization improvement led by Swasthfit, which continues to grow well. Our specialty portfolio continues to do really well. Our non-COVID, excluding RT-PCR volumes, has grown by 2.5%. Now, this has been a bit below what you would normally like to have. But as the year progresses, we are looking for a smart recovery in these numbers on the volume growth as well. So yes, largely it was led by realization with multiple factors rolled into it. But as we look forward to the second half of the year, we should see the volume growth also come back in some form and shape.
Okay, so just a point on realizations, since the bulk of this growth is due to realizations, can you give us some more color on that? What is the price elasticity that you're seeing in the market? Do you think further price hikes are even possible? And has competitive intensity now completely petered off?
Yeah, so we had taken some price adjustments on the high-end portfolio of our business, which was more manual, more technical oriented, given the large rising input cost on those counts. And we are happy to kind of confirm that the pricing adjustments we took has really settled in well. There has not been a significant kind of what I would call channel pushback, etc. It has really rolled in smoothly well. So that has contributed to what I would call a bit of margin improvement and a bit of top line as well. But the more heartening thing around the whole realization improvement is on this Swasthfit mix, which is a bundle test portfolio, now going at 112 crores for the quarter. So if you extrapolate a number, we are looking at a 500 crore kind of run rate for this product line, which we built from scratch. The second is that there has also been a positive impact because of the high-end test portfolio, which sells at a higher realization per patient compared to the routine test portfolio. Third thing which worked in our favor for this quarter is that Delhi NCR, which was kind of a low growth market, showed a step up in the growth profile, given that it benefited from an advertising campaign we launched this quarter to take the discussion away from price. From a competitive intensity point of view, yes, if you look at from a past perspective, the money being spent by all players have come down, but the intensity vis-a-vis pre-COVID continues to be high. So that is what we are currently working through the whole scenario. Coming to further price increases,
sorry, go on.
On price increases, our view is that we must take price increases only when necessitated by cost input increases and not to kind of drive revenue growth up. So our efforts are going to be centered around getting the volume growth up back to what we would like for it to be.
Okay, no, got that. No, fair enough. That's a fair bit on realizations, but the no growth in patient volume, I think that is the big concern here. You're saying you will see improvement.
So let me demystify the patient numbers. Last year, Q1 had a very high base versus the historical past. Close to 25% of the patient revenues was in quarter one last year. Now, there could be multiple reasons for it. One is the Omicron wave and the following H3N2 wave kind of coming into the picture, etc. So net of COVID revenues, I think our patient volumes grew at 2.5%. Also, sequentially, we grew volume out about close to 8%, and that is very heartening because if you look at a sequential trend, that is what will really drive this business forward. So that is the reason why we say that, with the coming second half, we will start to see a better number on volume. Currently, the volume number is not flat. I mean, it's flat on an overall basis, but if you kind of peel the onion, then it is a 2.5% growth, albeit not what we would like for it to be. But yes, it is a 2.5% growth on the non-COVID volumes.
So Bharat, what would volume growth, patient volume growth in FY, what would you estimate? And given the better realizations, what would revenue growth overall look like in FY24? Would you be in double digits, early double digits?
Our historical averages have been around double-digit number, and that is really what we are trying to get to. So this quarter's numbers really prove that we can get to a double-digit number at 9.7, 10% growth is what we delivered on the non-COVID portfolio. And as the base of COVID portfolio gets off completely in Q2, I think a 10% growth should really, or double-digit growth should be really sustainable.
All right. Hi, good morning, sir. I want to ask you about Suburban. How is that shaping up? And also, there is a concern with regard to the margins out there. So how do you see the margin trajectory improve for Suburban? It's given you good geographical exposure, but on the margin front, there is some kind of overhang from a stock market perspective. Go ahead.
Wonderful, yeah. Suburban was acquired for building a large business in the West, and these businesses are built over a period of time. It takes 5, 7, 10 years to kind of build this up. Now, having got this platform, what we are really working on is putting the growth drivers. Last quarter, we launched a new thematic campaign in the city of Mumbai, which got us extensive visibility and patient feedback saying, yes, Suburban is now visible, what it used to be in the past. So we are investing in growing the business. There has also been a strong D2C campaign launched to acquire customers digitally and play the home collection route during this monsoon and fever season, or vector-borne disease season. So that is something which we're trying to build the business. From a margin perspective, what we're really trying to do is to look at the synergies between Dr. Lal Path Labs and the Suburban ecosystem to be able to derive the maximum benefits possible. If you look at the infrastructure of Dr. Lal Path Lab and Suburban together, my estimate is in the region of West Maharashtra, at least, we should be number one from an infrastructure perspective. So the whole effort is now going to be saying, how do we get synergy between these two assets to be driving the growth in the Western market of the country? And that should start to fuel in the margin because we'll obviously harmonize quite a few systems here.
Okay, all right. That was about that acquisition. But sir, what about the cash in your books? You're sitting on some good amount as of now. Could you give us the updated number? I think it's around 800 crores approximately. And are you on the prowl again? Are you looking at some more inorganic growth?
Yes, if the opportunity comes right, and we are focused on building more business in South and West. So that is where we will really be looking at M&A opportunities, provide a right quality of asset at the parameters at what we set out to achieve really comes through. So yes, we are focused on driving the business forward, getting the top line, the patient volume, the margin mix right, which allows us to invest back in the business. And as opportunities come, yes, we would be open.
But are you on the prowl? But in 2023, should we hear something?
We are currently focused on getting the Suburban acquisition fully integrated. I think this is going to take some time and effort. But in the meantime, if something comes up, yes, of course, that will be a different discussion altogether.
Sorry, just to round that discussion off with a margin number for the full year, would you be around this sort of 24 to 26 odd % for the full year, Bharat?
So yeah, from a margin perspective, we always said that we would like to get back to the pre-COVID margin level, which was about 26 odd %. And we feel confident at this stage that we should be able to achieve the 26% margin profile. Yeah, the pre-COVID margin profile, that should be definitely achievable.
That should be achievable. And for SwasthFit, which is now about 22% of your revenues, I think you did give us some numbers. On an annualized basis, what are you expecting to do?
We should run about 500 odd crores on SwasthFit. I think that is a good step up what we have built. And when you look back, I think it's been a very good journey on SwasthFit.
So you're expecting an acceleration because I think you did about little over 100 crores. So through the course of the year.
We did 112 crores in the last quarter. We did 112 crores in quarter one. So I guess we're not really driving it. It's the patient adoption which is happening, and we feel happy about that. Yeah. But we will launch more variants of SwasthFit, more targeted, more sharpened portfolio that should provide more value medically for our patients.
Okay, Bharat, finally, speaking of launches, I think the guidance says that you will be adding, what, 15 to 20 more labs in the coming year. What is the overall plan for the year, both for Suburban and for the mother brand? And also just give us the sense of, cash funding and, how you're looking on the financial side as you roll these centers out.
Right. So the way we have kind of said is that we will grow in clusters to really support the hub and spoke model. So all our effort is adding new infrastructure, be it collection center, pickup points, or even our own processing labs in a cluster-based approach. Having said that, we are currently focused on building large amount of infrastructure in tier 3, tier 4 cities, because that is really an underserved area. So all the labs we launched in quarter 4 of last year or quarter 1 of this year, or what we will do in quarter 2 of this coming year, will all be in tier 3, tier 4 cities of the country, spread across northeast and parts of, as we look forward to the second half, we will open some more labs in west and south as well. So we are really looking at building a cluster-based approach in tier 3, tier 4 cities across the length and breadth of the country. From a cash perspective, like we discussed, we are sitting about 700 odd crores of cash. And as and when we get a good opportunity to deploy the cash, yes, we'll definitely come back and update.
All right, look forward to speaking with you again soon. Thanks very much, Bharat, for joining us and running us through all of that detail. Thanks very much. Well, that's Dr. Lal Pathlabs with some outlook. The market's down 23 points, so it's largely sideways. By the way, market breadth has flipped a little bit, so more declines as compared to advances early on. So watch this one as well. Nothing new, at least not on the downside. RVNL, Piramal, Sona Comstar, HPCL, Motherson are some of the names which are coming up on the downside.
I just wanted to point out Reliance Industries. The reason that we have recovered from a negative 50 to a negative 20 points on the Nifty is Reliance Industries, that big point there, putting in a bit of a fight as we speak. So just thought I'd point that out.
Absolutely. That's picked up quite a bit from in the last 10 minutes or so. So that's the reason why the market's picking up. Well, we'll take a quick commercial break here. We'll be joined by the management of Sterlite Tech and CG Power, one after the other, to discuss their respective quarterly numbers. Stay tuned. We have Sterlite Tech up next, and then after that, CG Power. Stay with us.
Welcome back. Well, the Nifty is mildly in the red now as we speak. The bulls putting in a bit of a fight. Sometimes this expiry-related issue that played out yesterday, it keeps the markets a little bit more prepared for the bad news the next day, because yesterday we saw a slam dunk in the last 60 minutes or so. But it's earnings season, so let's get straight to the next management. It was a soft quarter coming in for Sterlite Tech. Revenue growth was weak. The order book continues to remain flattish, although margins expanded. The company has lowered their FY24 guidance to around 7 to around 9% from around 10 to 12 earlier. Ankit Agarwal, the MD of the company, joins us on the show. Hi, Ankit. Good morning. Well, you've lowered your guidance, but you're still sounding reasonably optimistic because 7 to 9% in comparison to 10 to 12%. So give us some details. How do you see this shaping up? And also give us a trajectory on margins from here on.
Hi, thank you for having me on the show. So as you said rightly, earlier we had looked at full year basis, we had looked at 10 to 12% earlier, versus now when we see the market and our conversations with our customers across Europe, across US in particular, we now see that we are now forecasting between 7 to 9% growth. As we had shared earlier as well, fundamentally, we continue to see quite strong demand, particularly for the optical fiber on the back of 5G, fiber to the home, and the hyperscalers. What we do see is that there is some inventory, particularly in the US market. And result of that, there is some period of time as that inventory gets depleted over the Q1 and Q2. We do see that we will see improvements in our sales volumes, particularly in US and also to a smaller extent Europe, as we get into second half of this year. So on the back of that, we found it prudent to look at the guidance, and we've reduced our guidance accordingly. In principle, we are also looking at how do we scale up in other geographies, particularly in India. We do see strong demand continuing on the back of 5G, and probably towards the end of this year, we should see some demand coming on the back of BharatNet kind of projects.
Ankit, hi, good morning. Prashant here. What does this mean for, so it's an inventory issue, as you explain it. Otherwise, demand trends remain pretty strong from a longer term perspective. But what does this mean in terms of pricing, what you're able to charge, and then margins for the full year?
Yeah, absolutely, Prashant. So as we shared, so our margins have been healthy. We've actually taken a very strong look at our costs and looking at our cost to serve our customers. Definitely, there have been areas where we continue to focus and improve our efficiencies. We've also seen now some of the logistics costs come down and some of the raw materials have stabilized. So we are looking at all the elements of if our volumes come down, which we have seen in Q1, we may see it continue in Q2. We are taking several measures to reduce our costs as well. So to that extent, we are holding on our margins. Currently, the price realizations continue to be stable, but we may see some of that coming down in Q2 and maybe partly in Q3. Overall, we are still looking at how to continue our profitability, particularly in our optical business, which is north of 20% EBITDA margins.
Okay, got that, Ankit. So, let's now just talk about the overall growth picture. As you're mentioning, at least on the volume side, there is not much problem in the optical fiber business. Let's talk about services as well, where I think the stated intent is to, be a little more selective in the kind of contracts that you execute, the kind of works that you execute. And I believe that you were expecting a pickup in the UK markets. So talk to us a little more about services, and in terms of the revenue pie, FY24, how much will come from both of the segments?
Sure, absolutely. So at a macro level, we are in the business range of around 6,800, 7,000 crores if you look at last year. And so broadly about 1,700 crores of that came from the services business, and largely the balance came from the optical business. So from a split perspective, probably that kind of ratio will continue. What we have guided specifically is that we are very focused on taking certain projects at the right margin level. So that discipline is definitely now in the business, taking business at the right margins, right kinds of customers, and most importantly, ensuring that the cash and the fund involvement improves. So that's the focus that we're doing, as we guided yesterday as well, particularly in some of our government projects where we are now looking to hit certain milestones. We do believe that probably by second half of this year, we do see us hitting some of those milestones and generating more cash. Broadly, we have moved from a range of about 3 to 4% margin to closer to about 7 to 8% margin. So that's something that we'll continue to drive going forward. One big trigger clearly will be, BharatNet kind of projects where there's about 80,000 crores spent by the government, and STL will look to play a leading role. Similarly, NHAI has now talked about anywhere between 10 to 20,000 kilometers of highways being built, where there will be a fiber core at the heart of those highways. So some very interesting projects that are coming up in India as well. We will be very selective in which of these we pick up. On the UK side, there has been some consolidation of the internet service providers in the UK, which has led to some temporary reduction in deployment in the UK. So we continue to be bullish on the UK, but I think when we look at Q1, there was some slowdown. We see that probably picking up by certainly by H2 and probably by Q2 itself.
All right, Ankit, so we've got a fair idea about the operational performance. What's the updated debt number and reduction plans from here on?
So broadly, we've been at a flat level of debt in the range of around 3,200 crores net debt. And we continue to, while we talked about our revenue guidance going 7 to 9%, we continue to maintain a target of going to net debt to EBITDA of 2.5 times. So as we said, our focus on the business is now to clearly generate cash and to reduce the debt going forward.
Ankit, just a question on the margins, because from what you described, on the optical fiber side, pricing may come off a little bit. But on the services side, you're very focused on winning high margin orders. So net at a blended level, you're at 13.4% roughly right now at the end of Q1. What's the margin outlook? What's the range that you'd like to see the company at?
I wouldn't be able to give a specific number, but I think definitely, as I said, on optical side, we want to maintain EBITDA north of 20%. And we want to specifically look at services margin being north of 8% and eventually take it to 10%. So that's clearly a priority for us. And the second one is to look at the cash generation across the businesses and reduce the fund involvement.
Okay. Speaking of funds, just want to check this. I believe that you're planning a rights issue as well at some point this year. Can you give us some more idea if you are looking to raise any further money? What could be the size, quantum, and why would you want to raise more equity?
So as I said, firstly, our target is to take the net debt to EBITDA to 2.5 times. That currently does not factor a rights issue. That is through our cash generation of the business. We are continuing to evaluate the opportunity for the rights issue at probably the right market conditions and looking at the business requirements. We'll continue to evaluate that.
Ankit, we'll leave it there. Thank you very much for joining us. And it's always a pleasure having you here on CNBC-TV18. That's the management of Sterlite Tech. Stocks absolutely flat this morning. Well, lots of stocks, interesting stock moves. And I just want to take note of two names. One is, if you can put up RBL Bank, that is now moved to the high point of the day. It's up 4%. This is, of course, our story, our exclusive story, which, of course, got confirmed. Not RBL Bank. So that's 242 on that one. And look at Kajaria Ceramics after that. Numbers came out recently. I think there was a call, but the reaction is coming through this morning. That's up a full 6% now, Kajaria Ceramics. So two names there. Well, let's move on. We've got the management of CG Power joining in. It's been a very good performance from the company. Revenues are up 13%, EBITDA is up 38%, margins have expanded almost 300 basis points, and order intake is looking pretty healthy as well. Mr. Natarajan Srinivasan is Managing Director and CEO at CG Power. He's joining us to take some questions. Mr. Natarajan, good morning. Great to have you with us here. Thanks very much for your time. The power segment especially has seen a significant uptick in terms of order intake. Can we start there? I mean, is that segment looking very buoyant? What are your expectations for inflows for the full year in this segment?
I think the power segment, as of now, the order book, unexecuted order book, is about 2,820 crores, of which the transformer is actually about 1,730 crores. As I mentioned earlier, there is a significant investment which is going into the power sector. So demand for both for switchgear and transformer will continue to be high, and not only for us, I think for all the players. We have capacity constraints to take more. This will take about 12 to 14 months to execute. But order flow is strong, and then inquiry is more than 10,000 crores.
Inquiry is more than 10,000 crores, which means potential projects which may be put together. Okay, deal pipeline. Deal pipeline, yeah. And you said you have, that's a good problem to have, constraints to take in more orders. So how does that get resolved? I mean, in terms of capacity expansion, etc.?
So we have already announced an expansion whereby our capacity in the power transformer will go from 17,000 MVA to 25,000 MVA. But even that will not be adequate. We are looking to see whether we can look at some acquisitions. How many opportunities are available?
Okay. Sir, you mentioned that there are order inquiries to the extent of almost 10,000 crores. Is this more on the power side, or are you also factoring in all the industrial orders that you're getting? And give us a sense between power and industrial, where do you see sort of a bigger buzz and heightened activity, ordering activity?
No, the number I mentioned is only on transformer and switchgear, substantially relatable to the power business.
Power. Okay.
It could be renewables or solar or even fossil fuel, all these put together.
Okay, so power is looking very good. You have lots of inquiries lined up. Give us a sense on ordering on the industrial side, because even that business, I mean, in terms of revenue, even that business has seen a decent growth, and that's the lion's share of your revenue right now. So what are the different industrial clusters telling you? What's the outlook for the rest of the year?
So you are talking about industrial segment?
Yeah.
So industrial segment, we report to both railways and motors, and motors are expected to grow in double digits, and almost all the segments, no individual particular industry is actually having a concentration. Water, sugar, ethanol, infrastructure, all are actually firing. So each one probably is growing about 7 to 8%.
Okay. All right. Hi, good morning, Mr. Srinivasan. Two-part question I wanted to ask you. Railways, there's obviously a big push out there and a great potential as well. So as a percentage of your business, what is it and where is that headed? And since we just spoke about motors, LT, HT motors as well, what is your market share and have you gained out there?
So in railways, actually, we do about close to about 1,000 to 1,200 crores annually. And there are opportunities, huge opportunities in railways, but on the project side, primarily in the upgradation of locos and Vande Bharat trains, etc. So those areas, unless we are able to tie up with a player who has got the experience and eligibility criteria, we will not be able to directly participate. But we are also looking at opportunities whether for some subcontracting jobs in respect of those who already have got some orders. So this year also there are some orders are likely on the Vande Bharat side. We are talking to some people. But as of now, nothing has been formed up, so we are not able to say anything more. So coming to your second question on HT motors, that is what we call industrial motors. Our market share is about 16%, whereas in the LT motors, our market share is about 35%. The LT motors is growing. There again, we have some capacity constraints. We are taking some steps to expand the capacity. I see our market share probably from here onwards to move to about another 3-4% by end of this year.
In which segments, sir? In both the segments or?
In LT motors, I think we are 35% that will continue to retain that share. In the HT motors, from 16%, probably we can move up to 20%.
Okay. And just to go back to that earlier point in switchgear and transformers, you said capacity expansion is on track, but that won't be enough. You'll look at some acquisitions, etc. Anything we should expect soon, sir?
So not really, I think, because as of now, nothing is formed up, but we are constantly on the lookout.
Okay. This is largely going to be in the unlisted space?
No,
smaller capacities?
Everything is open. So we get some proposals every now and then, but as and when it's finalized, probably I'll be able to
You want to tell us about the size?
No, nothing is formed up, I cannot say anything.
Mr. Srinivasan, you can tease us a little bit,
I think he is teasing.
Yeah, we know you're on the prowl. Just tell us the size. What is the size of the acquisition?
No. Everyone will be interested today because the industry has got so much of demand. So it will be a lot of competition. We have to wait and see.
But it's 100, 200, 500 crores, more than that?
Don't ask me anything more. I'm sorry to say.
I tried my best.
Okay, so last time I think on the last call after the last quarter Q4 earnings, you had said that margins will be at around 14% for this year. Now, considering the strength in the business, and as you mentioned that the ordering activity has really picked up, do you think there's a scope to improve that margin guidance at all? And also just tell us about the expectation on order book growth on both sides, power as well as industrial. If you could give us a number of the order book growth that you'll see on both sides.
So as first as regards margins, 70% of the cost of production is way of material cost. We have mainly copper, iron, steel, aluminum. So I think if these prices move, definitely we will not be able to maintain margins. So as of now, we are not expecting any significant volatility in these prices. There is volatility, but it will not be, as of now, it is maybe controllable or manageable. Therefore, we will be able to maintain this margin. Beyond this, I'm not sure whether we'll be able to increase the margin because, these are all tender-driven business. Railways is tender-driven, power sector is tender-driven. Therefore, you have to compete and get the order. As far as motorists is concerned, the kind of competition from very large players. So there is very little scope for you to increase the selling price the way you want. Therefore, I would be happy to maintain this margin at this level. Coming to order book, as of last year, 30th June of last year, was aggregate order book was 3,500 crores. It has grown by about 40%. As of this June 2023, I think order book is close to 5,000 crores, 4,909 crores to be exact. And the inquiry is further strong. So therefore, I don't see any problem in order book. It's a question of execution.
Okay, all right. Final question then, sir, before we let you go. For the year, for the entire business, margins you're going to maintain, what kind of growth are you looking at? And a couple of sell-side notes, they are highlighting that exports could be big potential. Currently, it's not too large. So could you tell us about that? Do you see a large potential? Do you have a ballpark number for exports in mind?
See, for the year as a whole, as I maintained last year, our targeting to go about 15%. And this quarter, actually, we lost about 40-45 crores of sales due to our internal, also some cyclone effect, etc. Otherwise, target is to maintain grow the top line by 15% for this year, I think. So given the order book is definitely there. So if we execute, definitely we will able to reach there. As regards your second question, exports, unless and until the domestic demand is so strong, unless and until you have a sufficient capacity, we will not be able to go big on exports. All the segments, three segments, actually the domestic segment is very demand is strong. We are struggling to meet the demand domestically. While we are taking steps to seize the market and then pick up upon dealers, customers, etc. When we probably our expanded capacity comes into force, that we will be able to affect maybe next year and year after.
Mr. Natarajan, it's a pleasure always speaking with you, sir, and we look forward to having you back on soon, and of course around the time that you announce that acquisition as well, whenever that is. Thank you very much for joining us here on CNBC-TV18. Thank you. Well, the markets actually moved into the green. So that is that's interesting to note. Let me just take a quick look at what the day's low was. Pretty close to yesterday's low. The low is 19,598. Yesterday we got to 19,603. So similar lows, and then there's a bit of a bounce. Ajanta Pharma is the big mover, 6%. Good earnings. Ekta is here to shine a spotlight on once again. Ekta.
Well, yes, it's a good performance for Ajanta Pharma. The revenue is up around 7%. This is better than, or largely in line with expectations, but the EBITDA has come in better than expectations. So the margins have come in at around 26.6%. The street was working with around 23% for the quarter, and that has resulted in a better profit, which is coming at around over 200 odd crores. The street was working with around 163 to 165 odd crores. Now, a couple of key points that stood out is that geographies such as India has shown double-digit growth, so it's up 14% year on year. US has reported an over 200 crores in terms of revenue, so that's up around 19%. The company has also turned 50 years old, so they've approved their first interim dividend of around 315 odd crores, regular dividend of 10 rupees, special dividend of 25 rupees. Just a couple of key points from the conference call. They've maintained a guidance of 25% in terms of margins for FY24. They've guided for mid-teen year-on-year growth in branded generic segment, and they indicated that for price erosion, it's much better than earlier. So that's definitely a positive. Mid-single-digit growth in the US is expected. This is excluding any benefit from a non-smoking drug called Sensex generic. So looking good for Ajanta in terms of guidance as well.
Okay, got that. Thanks very much. It's quite the mover today in terms of earnings reactions. Thank you for that, Ekta. Well, let's actually take the conversation forward on pharma stocks, and then this is a big sort of surge that we've seen. Nithya Balasubramaniam, Director Healthcare at Sanford Bernstein, is with us. Nithya, good morning. Thanks for taking the call. So it's been, lots of green cheer thanks to these pharma companies. I want to get your sense on the takeaways. Look at what Cipla said about the US market and the strong growth that they posted there. Even Ajanta, they're talking about how a lot of the price erosion is coming off to now single digits. Your sense on what we've seen, and if one is to take a call on US generics, A, whether you'd go for that, And then B, which would be the best play for you in terms of the stock choice?
In the near term, I do believe price erosion is much softer than before. I think we've spoken about this compared to last year, where price erosions were trending in the 15 to 20% mark. I think it's much softer at about low single digit this year. And I would imagine that sustains at least for the rest of the calendar year. It's difficult to say whether this will sustain beyond that in a longer time frame. But beyond that, I think the sector is also seeing additional tailwinds in terms of companies finally being able to take advantage of API costs having improved, API and raw material costs. A lot of them are sitting on high price inventory. I think they've burned through that, and now they're enjoying the benefit of API costs having come off to pre-COVID levels. Freight costs are more reasonable. And for companies like Cipla and Alchem, which have a higher NLEM exposure, they've also been able to take a 10 to 12% price hike this year. So I think across the board, the theme right now seems to be better margins this year, both gross margins as well as EBITDA. And in terms of what we would play, I think in terms of our 15 to 1 year to 15-month view, we'd still like Sun, Cipla, and Biocon. But specifically, if you're asking me about the US tailwind and names to play there, I think Aurobindo is more exposed. There are also some supply disruptions. So in the near term, I think Aurobindo should be able to benefit.
Hi, Nitya. Good morning. Nitya, in the top few stocks that you mentioned, Cipla featured. Yesterday, my colleague Nisha, she broke the story that finally there could be a stake sale that could be on the cards. Wanted your comments on that. We've heard it before, but it seems there's something brewing now.
I think the promoters, Yusuf Hamid and Mustafa Hamid, are obviously in a place where they need to think about succession planning. Samina Hamid has been involved, but not in an operational role. I think in the recent past, we have seen that Umang Vora had operational control. And I would imagine going forward, they want to continue to have a professional management in place. What's broken so far, I'm not privy to details, but based on what's in the press out there, it seems like they're trying to sell about a 25% stake out of the 34% that the promoters hold. To possibly a consortium of private equity. So we would imagine that when any private equity or a consortium comes on board, we would imagine that they would want to continue to run the company through a professional management. It's worked well for Cipla in the recent past. I don't see why it should be very different if a consortium of private equity were to take over.
Okay, so operationally, you don't see any hiccups. I guess the market anyway gets excited if someone's going to come in and buy a large chunk of equity, open offer, all those kind of buzzing scenarios will start doing the rounds. So I guess explains a lot of the excitement, both on fundamentals and some of these other possibilities around the stock. Thanks, Nitya, for joining in. A short call, but a very useful one. Thank you for giving us the perspective. We need to take a very, very quick break. On that note, on the other side, the latest on commodities as well as the top trading ideas now at 10 o'clock. Welcome back. Well, the markets have been pretty iffy. It's all over the place. Suddenly, we are starting the southward journey once again. And you have a couple of the banking and IT names to blame for that. ICICI Bank, HDFC Bank are big drags, as is TCS. Okay, let's go to Mitesh. Mitesh, anyway, you were saying that you are more keen on looking at stocks today. But this whole flip-flop on the index, would you trade anything at all? Nifty, Bank Nifty?
I think, the Bank Nifty is clearly underperforming, and that's where the intraday charts are also on the weaker side. So buying into Bank Nifty puts, unless until the spot starts getting past 45,800 again, could be a good idea. And I think on the lower side, I would be looking at a test of 45,000 and in the worst case, 44,600. So I think there's a good chance of us heading towards 44,600, which is roughly about 800-900 points lower from here. So I think the Bank Nifty over the next 2 days will be under pressure. Even on the stock side, I have a sell call on Axis Bank. It's a conditional sell. I'm just waiting for that level of 945, 944 to be taken out, and we have had a low of 942 today. So let's keep it like this: sell below 942 with a stop at 953. Look for targets of 920 there. And on the buying side is NTPC, which I would recommend buying with a stop at 199.5 for targets of 208.
Okay, got that. Tej, thank you very much. We'll come back to you during the course of the day. Let's now look at commodities as well. And we have Manisha Gupta in the house for exactly that. Manisha, what do you have your eye on?
Well, metals, because, the last couple of days were positive. We saw some buying coming in, but that clearly has turned in the New York session yesterday with two global central banks putting up rate hikes and the dollar index back up again, 101. We are looking at pressure here. Add to that the fact that the China stimulus has still not come and the demand from China remains on a muted side. Also, when you look at inventories, those seem to be gaining. So when you look at copper, we have seen production increase and the inventories also gain up. So in the year 2022, between the first 5 months of the year, we saw a deficit of 74,000 tons there. Now in 2023, we have turned that into a surplus of 287,000. So we are sitting on much higher inventories at this point in time. Also, when you look at the surplus estimates itself, so while for 2023, it's 100,000. In 2024, that is expected to increase to 188,000. So the next 2 to 3 years, a lot of copper projects are expected to come online, and that would mean more supplies coming into the market. And copper is not the only one. That's exactly what we are looking at in other metals as well. Aluminum, for example, well, the prices have seen a decline of nearly 5% in this year. And from the highs of 2023, we are 15% in the negative from there. Here as well, when you look at the supplies in the global market estimates there, well, 2023 is staring at a deficit of 191,000 tons. But next year, that is expected to go half or less at 66,000 tons. So we are looking at more supplies increasing in aluminum as well. Nickel continues to be an underperformer in the sector. It is used in steel and in EV as well. But the prices have seen a decline of 27% in this year. There is rise in Indonesia output, and that has been weighing onto the markets. Here as well, to begin with, we are in surplus. So this year, the surplus is seen as around 200,000 tons. Next year as well, there would be a build-up on that. So 150,000 tons of a surplus next year as well is what you can see in nickel. So even with all that EV demand and energy transition, many of these metals are expected to be in surplus this year and the next as well.
Okay, got that. We'll watch out for this. Thank you very much, Manisha, for all the details. By the way, I just want to leave viewers with the key levels to track once again, because we briefly went below the 19,600 handle, and we're once again precariously close to those levels right now. The next level to watch is going to be the 20 DMA on the Nifty, which is closer to the 19,550 mark. So let's see how this goes. Banks are where the problem is. The Bank Nifty is at the lows of the session. HDFC Bank, ICICI Bank, Axis Bank, all of these stocks on the lower side of the screen. So banks are weak, as are some of the other names like Tata Steel and Hindalco. They had a great start to the week, some of these metal stocks, but right now they are cooling down. Reliance is actually the key support for the market, and if anything shifts over there, then the Nifty could have a bigger problem. So that's the setup, at least for the time being, at around 10 o'clock. We'll take a break on that note. On the other side, we'll have Lata joining in, and she'll connect with Puneet Chatwal of Indian Hotels to discuss the company's first quarter performance.
Welcome back. We stick with corporate results, and it was actually a good performance from Indian hotels. It's a huge 30% improvement in the profit and about a 16% rise in EBITDA as well. The reason why we could call it mixed is if you compare it quarter on quarter. Fourth quarter is always the strongest for the hotel industry. It was for Indian hotels, and so if you compare with that, the occupancy looks like, about 0.5% lower. But we have the man of the moment with us, Mr. Puneet Chhatwal, Managing Director and CEO of Indian Hotels. Good morning, Mr. Chhatwal. Always a pleasure having you with us. Well, it's a strong year-on-year rise in occupancy from 70.4% to 74.7%. But you spoilt us with an ultra 75% plus occupancy in the fourth quarter. How do you see it now with the events lined up for the year?
I think, firstly, thank you for having me. The seasonality in the business is there to stay. I think Indian Hotels or any other hotel company cannot change that, especially with a diversified portfolio like we have. So just a correction, Q3 is traditionally the strongest. Q4 is the second strongest. And if you get Q1 as a good start, I think then you're in for, you're ahead. Normally, if you go back 5 years, 7 years, 10 years, Q1 and Q2 have not been profitable, definitely not for Indian hotels. So I think if we start on a good note, the Q3 and Q4 can only augment the performance of Q1 and Q2.
Okay, you must have been seeing the benefit of the revenge travel that we saw after COVID. What is your estimate of consumer sentiment now? Does it remain strong? You may already have pre-bookings for up until Q3 as well. And then you have all those events, beauty pageants and, test matches. How are you estimating? Do you get back to 75 plus?
Yeah, so let me say, number one, consumer sentiment is strong. The sector, besides being hospitality and food and beverage driven, is now slowly also becoming a more consumerism driven sector. That's number one. Number two, demand remains strong. It's continuing to outpace supply, which is going to stay constrained because of COVID. Not much construction of new hotels happened. Third, the infrastructure spend that the government is doing, especially opening of places like Pragati Maidan day before yesterday, as well as Dwarka or Jio in Mumbai, is going to create new demand, which we have not seen in the past. Fourthly, I think from our point of view, we have embarked on a journey of a very strong growth. We have 79 hotels in pipeline. We've opened 5 hotels in the first quarter, signed another 11. So I think our guidance has been we'll open 20 hotels this year. So the not like-for-like growth through both asset management initiatives of our renovations, smart renovations of existing assets, coupled with the not like-for-like growth, should drive both operating leverage as well as the EBITDA margins going forward. So all in all, we are pleased, and last not least is the introduction of new concepts, is the collaboration with Tata Neu, which is also helping us a lot in the last few quarters. So I think that loyalty-driven revenue has increased for us. Our new F&B innovations has helped us. And as I said, our smart renovations and ancillary businesses like private membership club, like a Chambers, the renaissance of the Taj Club lounges is all helping us to drive premium performance and quarter after quarter delivering the best quarter.
Okay. Oh, that's good to hear. Let me take one by one. You spoke about consumerism and the range of products you're offering, and you spoke about costs a wee bit. Tell us costs. I mean, that obviously could have impacted a bit since costs have gone up. Even your personal costs have gone up a bit. Is this just a one-off? And do you think revenues will beat? How will margins, how will costs progress from here on and therefore impact on margins?
We have given a guidance of 33% margin, and in our capital market day, a lot of questions came that if you have done almost 31.8 in last financial year, should that number not be higher? And we said, no, we are going to invest in our businesses for future. And we rather have a larger top line and a 33% of that than to have a cost-driven model only. So the idea is to improve the revenue to the extent possible and optimize the costs. And we have been spending monies on marketing for our new businesses like Cumin, like Ama, and we also call Ginger as a new business. And we are very excited to look at the launch of Ginger in Santa Cruz, depending on the monsoon and the strength of the monsoon and when it subsides. I think target date is 1st October, but latest would be 1st November. And that's going to be our flagship in this new business. And, we will be spending monies on marketing and other expenses related to it. Same thing on personnel. I think we tend to forget that last year in the Q1, it was immediately after the third wave was beginning to subside, which was popularly called as the Omicron. And the cost base was different. I think if you have a year like the sector has had last year, including Indian hotels, and some of those wage settlements with the unions, some of those increase in employee capacities to support new businesses is a given. And I think still boasting of around 30% margin, which includes international business, because on standalone, we are already at 36, even in Q1. I think for hotel sector, that's a very, very high margin. It's a global benchmark almost. Not many companies could boast of 30 plus percentage points on a global basis.
Yeah, anybody who makes a profit of 1 rupee over every 3 rupees they earn is doing a damn good business. I'm not taking away from that. But, Oliver Twist always asks for more. Time permitting, I'll come to international expansion. But let me ask you about Taj Sea Rock. Have you figured out how much investment you will need to make and you will make?
Well, Sea Rock, we are in the process of getting permissions. And for all the reasons we all know, it just is getting a bit delayed. And we remain optimistic that by the end of this year, we will have the preliminary permissions that are needed. The management's focus is there because this is one of the biggest hidden potentials that we have in our portfolio, and maybe one of the last big issue that remains to be resolved. So we are working on it. We are on the drawing board. And we are in continuous exchange with the authorities, whether it is a BMC or MCZMA and hopefully very soon with MOEF to get the permissions. So that focus is there, and hopefully we will have a solution as soon as possible.
Okay, so now to the international expansion. First of all, when do you expect to be profitable? Is it profitable in FY24 itself? And what are your big plans, if any, in the international sphere?
Oh my God. We are profitable on international business. The question is how we report it. So some of those businesses, the management fees that we earn, for example, in Dubai, come straight to IHCL for a variety of accounting reasons. If we were to add all that back, international business is very profitable. Also in Q1 of this year, it has been profitable despite a challenging situation in San Francisco, which is beyond our control. And also some challenges we still have in our hotel in New York. But London has performed very well. Dubai, our management fee income has been very good. Maldives has been still going fine. And Sri Lanka is beginning to come back. So I think on the international front, on the existing portfolio is all good. Cape Town is doing very well, and so has Lusaka performed for us. Now coming to the pipeline. In the first quarter of this year, we added 2 contracts in Dhaka, which is for both a Taj and a Vivanta. So I think on the Indian subcontinent, that was an important capital city that we were missing. So in a few years, we can expect that to open. And we have already communicated all the improvements we have made in London, including taking our very famous Chinese restaurant concept called House of Ming, which opened in April in London and has been off to a great start. So I think that's where we stand. As per the changes in LODR as of 15th of July, we had to report an in-principle agreement we got for acquiring Lusaka, which we've been running for almost 4 decades. I think that's another opportunity, just like we did Cape Town at the peak of COVID. And we are not investing, but if we get a rent agreement, or it's called a lease agreement for a property in Frankfurt, I think that would be an addition of another strategic dot on the European continent.
You know, there's so much to chat, Mr. Chhatwal. I will have to invite you in between results seasons, so I'm not bothered by the numbers and look for more details. Congratulations and thank you very much.
Please don't hesitate to invite me.
All right, sure. Certainly not. Thank you very much indeed for joining us. Out of time on Bazaar, just wanted to add that the Bank Nifty is the one that's giving a lot of trouble, and that's directly related to what the BOJ has said, that they will allow yields to rise a little bit. So Indian yields have gone up, and that's impacting the Bank Nifty. Wrap up on Bazaar. Chartbusters up next.